Welcome to Telltales, an investing podcast hosted by Hunt Lawrence, Jason Wallace, and Mike Nicoletti. Each week we discuss topics ranging from geopolitics and macroeconomics to energy and technology. Follow along by downloading the memo. Get it and subscribe to Telltales.us. It's TELLTALES.us. Follow along by downloading the memo. Get it and subscribe to Telltales.us. It's TELLTALES.us.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
My particular car is at the airport. I was just way back. Jason's at San Diego. Jason, thanks for hosting us.
Oh, yeah, no problem.
Not too much on the price of oil. The withdrawal of Israeli troops in Gaza, the troops deployed in Gaza in the beginning, the high point was 50,000. And based on press accounts, it's down to 5,000. But the Israeli government seems determined to take on Rafah, the area in southern Gaza where the remaining Hamas militia are holed up, with hundreds of thousands of Palestinians in tents around them. So I don't know whether, from a political pressure point of view, I don't think the thing is resolved. That will probably help keep the price of oil in the mid-80s. Biden administration has apparently gone to the Ukrainians and said, we would prefer if you didn't put drones into Russian refineries, because Russian production is off at least 1 million barrels a day because of that. And of course, that causes high oil prices and high gasoline prices. And the Biden administration would rather have lower gasoline prices for their election campaign. The Israelis, with a drone or missile or something, hit a building next to the embassy, Iranian embassy in Damascus, and killed some senior Iranian officials. The Iranian reaction to that so far, in terms of military activities, pretty muted, but we'll have to see how that goes. I think it's fair to say, when you look at Exhibit C, and you see that there's at least 3 million barrels a day being held back by Saudi Arabia, 2 or 2.25, and UAE, 1/2 to 3/4. It's still pretty vulnerable to the extent that there is supply that could be added to the bucket that would bring the oil price down. Against that, we have this premium for risk premium in oil, given the events in Gaza and Ukraine and Russia. Exhibit B, natural gas price is somewhat better, and the 25 and 26 prices are holding up. Great deal of publicity, and we'll get Jason and Mike's commentary on this, but in that power line in production demand, where it was flat through 21 and then up 2 Bs a day in 22, 2.5 Bs a day, and then only 1.5 Bs a day in 24 and 1 B a day in 25. Those numbers, based on power requirements for data centers, especially data centers with GPUs in them, may result in that power demand going up by as much as it went up 23 versus 22. That will make a huge difference, because if you sight along the LNG line, power demand's going up faster or as fast as LNG is. So that's good for the price of gas. It's still oversupplied. And just like Saudi Arabia, I noticed in a news source this morning that EQT, which is the largest gas producer, has curtailed 1 billion a day of gas. So that's very impressive discipline. And so the supply, which has been the issue, is estimated 104, now running 100 or under 101. So that's good. Problem is that as we get into better gas pricing in the fall, I think we expect to see that EQT production. Macro, I do think that the combination of higher inflation reported this morning, continuation of higher inflation, so it's like 3% or 3.5% rather than the 2% target the Fed has, continued overspending, deficit spending by the government, pretty strong job market. The 10-year treasuries have, seemed to establish themselves in the 4.5% range and don't seem to want to go down. And federal officials making comments, which they can between meetings, and they get to within a meeting, they have to go into 1 week blackout, are really pointing this to just 1 or 2 clients next year. So a good question facing us all as investors is, will that begin to have an effect on stock market valuations? When interest rates went up a lot in 22, extra, all the companies that did so well in 23 came down in a significant way. So one of the things I think we have to be cautious about is today we're going to talk about specific companies having done antitrust impact 2 weeks ago on China impact last week. If we see valuations that we're a bit uncomfortable with, continued high interest rates probably call for not being quite as aggressive in acquiring shares, thinking that you may see the shares for less later, not because lack of performance in their results, but just because a possible kind of downward valuation in the equity market valuations in disappointment that interest rates aren't coming down faster. Mike, Jason, anything to add there?
No, not on my end. I do think that's probably the biggest issue facing us. I mean, Amy Diamond's comments the other day about interest rates could be 8% or so. I think it spooked a lot of people.
Yeah, I agree. When we started the year, we were talking potentially 6 rate cuts. Now we're talking 2, and it wouldn't surprise me if that ends up as 0.
Yeah. Having started, it's the fact last week. Why don't we start on page 1 this week? To skip to Tesla and valuation, Mike and Jason have done a great deal of work. Tesla, this is an old number, the 200. Tesla's down in the 160, 170 range. A good question is, if you want to own it, and I don't think amongst the 3 of us, there's any question that Tesla has distinguished itself. I mean, look at its balance sheet. It has no debt, $28 billion of cash at year-end. Its free cash flow is lower, and its deliveries in the first quarter were below first quarter of 23. So when they announce, I think that annual free cash flow number of 5 will have to be revised downward. But question is, with 3 billion shares or 3.2 billion shares outstanding at 150, that's $450 billion. Will it trade lower than that? And this gets into that impact that we saw in 22, where increasing interest rates were viewed as being a cause for downward valuations, especially with companies trading at fairly high ratios times free cash flow. Jason, how I think you and Mike, I understand, pretty well dug in the 160, 170 range. You could just fill out more of that logic or Mike or Jason, whoever wants to take it up first.
I can take it since we're both kind of involved in it, but the high level is we'd like to own more shares at 150. That was based, really, you go back to our prior calculations at kind of best operating margins, producing 2 million cars a year, you could get to a justification for a 20 times free cash flow number at 2 million cars a year. I'm kind of looking forward to more production, but we're in a situation where in order to maintain volume, they've had to cut prices and therefore the margins are lower. So kind of think this new approach to automotive production is going to cause maybe more cyclicality in long-term operating margins. So maybe that peak we saw before is maybe a little optimistic, and maybe where we are right now is more of a trough to the industry in general. But long story short, in order to enter that position at 150 today, you don't have that option right now. But what we were doing is selling puts that were in the $165 to $175 range, so that if those puts get exercised, our net and cost would be around $150 a share. So I say all that in that, so the last time we tried to buy Tesla, we did some of that, and a bunch of those puts didn't get triggered, and then we kicked ourselves for not just having bought the shares. But we may get a shot at buying some at 100. So you want to give yourself some flexibility to buy more if things get really irrational.
Hey, Jason, there's been publicity denied by Elon Musk that they were going to drop their plan to build a car that would be, I guess, competitive with BYD. Their Model 2 would be a less expensive car, and instead focus on building up their capability to have taxis without drivers pick you up at the curb. I guess the logic for not doing a less expensive Model 2 is basically margins. You want to try to compete with BYD or other Chinese manufacturers. Better to have something that adds more value. Being able to have a car that drives itself without having bad publicity because of accidents and whatnot. Or
Right.
How do you look at that as a Tesla investor?
Right. When I heard that rumor, it really kind of shocked me because Tesla's done a lot of work already around what the production line looks like for that Model 2. And specifically having that model as the one in mind as the robo-taxi. And Elon's always said they want to keep going down the market and have a cheap electric vehicle that everyone can purchase and own. So I guess the implication was that the Model 3 would become the robo-taxi, and it's not designed for that originally. So they can maybe release a new model that is more optimized on whatever their vision of a robo-taxi becomes. But, you mentioned the margins. They've redesigned the production line with the goal of building that production line in Mexico for a Model 2. They're going to prototype it in Austin first, but they're going to have a full-fledged factory in Mexico building Model 2s. So I think they're so far along with the plans that to hear them scrap them, it didn't really square with me.
Okay, let's take a quick break for a message from Oak Cliff Sailing.
Hello, I'm Dawn Riley, and over the weekend we had a wonderful art show that we thought you would enjoy, just spending a few minutes seeing the results. All art is available. Just contact us on oakcliffsailing.org.
Sama munul no bàyyi ma yow sama munul no bàyyi ma ndax sama nare naax dangay ma bàyyi ma bàyyi ma bàyyi ma bàyyi ma coow li bari na te noppi toll ni takk na sama biiru famille jox la fin du mois ndeke.
And now back to the show.
2 new pages this week. There's, one from last week, which is a comparison of JP Morgan, Morgan Stanley, and Goldman Sachs. In our family accounts, we've been long-term holders of Goldman Sachs. Have never owned JP Morgan or Morgan Stanley. In the last 5 years, both of those stocks have performed better. If I can just direct everyone to page 13, and for the people without the 20 pages in front of them, I'll try to talk it through. If you pick up a 10K, 10Q for either of these three companies and start going through the detail, you quickly decide if it's that complicated, is that really something I want to own? We've just been talking about Tesla. It's a very able company, but you can see, first of all, they have pretty good disclosure, financial disclosure, and you can see what's going on. It's impossible with JP Morgan, Morgan Stanley, and Goldman Sachs to see what's going on. However, there is a way to look at these. First of all, they do have free cash flow, and the JP Morgan free cash flow here is $56 million. That's a bit elevated from their acquisition of those troubled bank assets, which I think added at least $10 billion to their free cash flow. So I think when we look at them this time next year, they'll be lower. But I think there's some special addition to income and free cash flow from those acquisitions. Morgan Stanley had kind of a disappointing fourth quarter or end of last year, and they're $10 billion of free cash flow. And Goldman Sachs, who has been retreating from businesses, they wanted to go into more consumer-facing business. They're retreating from that. They had $15 billion of free cash flow. If you look at the revenue of these companies, let's just take Goldman Sachs and look at every 10K, every 10Q. Their revenue for last year was $46 billion. Comp expense was 15, their operating cost was 14. They paid $2 billion of income tax, and it really doesn't have any capital spending. So if you look at it that way, in other words, the comp expense will go down if they are less profitable. Goldman Sachs, all these show that they can reduce their comp expense if their results are there. It's really a pretty steady performer. And when you look at the rest of the cash flow statement of Goldman Sachs, they pay $4 billion a year of dividends. So they yield about 2.5%. And they bought in $6 billion of stock last year. So there's $5 billion added to retained capital. Similar numbers for Morgan Stanley, similar numbers for JP Morgan. I don't think, now these companies trade, Morgan Stanley's a little higher, but as I say, the results were a little less last year. They will trade for around 10 or 11 times free cash flow, about a 9 or 10% free cash yield. I think it's reasonable to expect a combination of buying in equity and, some amount of kind of organic growth. I think it's reasonable to expect their results increase by single digits, 5-6% over an extended period of time. So at a 10% free cash yield with 5 or 6% growth, you're getting up towards a 15% return. And as Mike and Jason because they spend a fair amount of time looking at, it probably puts you in the top quartiles, the top third, maybe top quartile, of all performing equities. So while they're difficult to understand, they definitely have position in the industry. We don't have other financial institutions. We don't have Citibank here, Wells Fargo, or BofA, but these are established businesses. And I think the great advantage of something that compounds at 15% a year is it doubles every 5 years. And you wouldn't want to have, if you own 10 stocks, I don't think you want to have every stock have characteristics like this. But these are very well established businesses. And, I think they're worthy of having one or two companies like this and companies you own. Jason, Mike, I don't think either of you are in running Top Mark inclined to own something like that, but just any commentary on my run through of those three?
I wouldn't say we wouldn't ever. So I do find the financials are harder to discern, but these three in particular are well run. There's a couple traditional banks that we've gotten close to, especially during that Silicon Valley Bank crisis. But I guess the downside risk is that if they are mismanaged, things can go south really, really quickly, just like the Silicon Valley Bank. These three in particular are more established and frankly more regulated. The market for banking is very different now than it used to be. So you're probably safer and bigger.
The other new page is page 15, called the Pfizer page. And there were some good articles in Barron's last weekend. One of the articles, I hope I have the right weekend, maybe it's the weekend before, talked about the big pharmaceutical companies and how they were challenged with their patents running out, and being large and having to find not just one or two significant businesses, with more than $1 billion of sales, but, depending on the size, maybe, the size of Pfizer, maybe 5 or 6 new ones, and just the real difficulty of doing that. But even if they were successful, yes, Pfizer had a run-up with COVID, no question. They had their joint venture with BNTX. But, I guess I characterize them as being in the same category as those three big financial institutions. Mason, is that their placement of Pfizer or categorizing of Pfizer, do you think, or companies like Pfizer?
Yeah, I would say it's lumpier growth for sure. Pfizer has a lot of revenue to replace, and the banks are more steadier growth. I guess they go through cycles where maybe there's M&A and IPOs are down, but Pfizer, I think, is maybe looking at larger bumps in their revenue. And like you said, they either have to make big splashy acquisitions or place a lot of bets on clinical stage drugs and hope they get a blockbuster in there. So it's probably a lot more difficult, I think, to replace the revenue for these kind of companies.
Right. I have a kind of a view on the bigger pharmaceuticals because they do have very large sales forces, right? And those sales forces bring some level of economies of scale. So at some point, the size of a pharmaceutical company actually becomes a distribution company and probably shouldn't be an R&D company. So anything they buy really ought to be, okay, we know that this thing, it's so close to being FDA approved that we're 99% certain it's going to come through. And we have like an idea what the market is like. Downside of that is you probably don't get it's not, you really don't need to hit home runs. You really need to hit really solid base hits and refill your sales, your revenue stack. And that's the tough part, right? You end up something like Humira, which is big drugs, but it does better than expected. Refilling that is no trivial feat. So, so they all kind of seek drugs that have really big TAMs, total addressable markets, really big market sizes. And so then you end up with all the big drug companies focusing on the same damn thing. And then what happens is you have multiple drugs servicing the same thing, and they have to split the pot some way or another, or price compete, or whatever. So a lot of those end up being kind of over researched and under profitable, I guess, in a way.
As Wednesdays, we spent a fair amount of time on LNTH, VRTX, both of which have good cash flow characteristics and a lot going for them. And we'll probably get back to them and run out of time this Wednesday, another 3 or 4 minutes. Jason, whenever we look at this page, you've been saying BioNTech deserves a look. I make the cash, just having looked at the year-end financials. The cash here, it's in euros rather than dollars, but the cash 17 billion euros, and the market value of the common only 21.6. I'm paying 4.6 for an R&D effort. Last year there was $1.8 billion, and they seem to have done a better job than Moderna. I mean, they actually had free cash flow last year. I don't know whether they're able to keep that up this year, and they have a lot of drugs and trials and whatnot. Of course, that takes a long time. To contrast them, I mean, these are the two companies that team up with COVID vaccines with RNA technology. But I mean, here you have BioNTech with $500 million free cash flow and Moderna with a -5. But you're much more familiar with the projects, the trials and whatnot with these two companies. If you were like doing an NCAA bracket, I mean, and had to pick BioNTech or Moderna, which one would you pick?
Oh, that's a tough question, especially when the research is earlier stages. I think BioNTech is trading at such a low enterprise value because they're facing a prospect where their revenue goes down towards zero. If you just take away, the COVID revenue that they have, they're cash burning otherwise. So, and we expect that to trend towards zero. So the flip side is they're both kind of going after the same indications. They want to make a personalized cancer vaccine or cancer vaccines targeted towards different types of tumors. Moderna this week had some pretty positive news around their personalized cancer vaccine. They tested it, and it was early stage. It was a phase 1 study with, I think, around 30 participants. But the results were extremely positive. So they tested using the mRNA vaccine alongside of Keytruda. So it's an immunotherapy for cancer, and it improved the survivability of patients from about 1 year to 2 years. So doubling the survivability. It's a big result, but it's very early. So they're both having success with their research pipeline, but it takes a long time to realize.
Jason, I may have missed it. What type of cancer is that with the 30 participants?
Right, because I didn't mention it. It was head and neck. So they're using their personalized cancer vaccine that they've tested against some other forms, and then this specifically was head and neck cancer.
Mike, Jason sounds like he's going to pick Moderna. Do you want to take BioNTech for your bracket pick?
Yeah, I think so, because I have no idea which trials are going to be more successful. So I want the company with a little more staying power that's burning slower, that also has lots of lottery tickets. And that's really what you're buying. You're buying a portfolio, a distributed portfolio of lottery tickets. And this R&D being able to acquire it at today's rates. And this is a lot of pharmaceuticals across the board, but in particular, these two companies, you are purchasing R&D. And the question is, does that R&D have any value? And we all know that mRNA vaccines were pretty revolutionary in a lot of different ways. And if you can translate, I mean, this is the story, right? You can translate that technology into something that can beat cancer. I mean, we're talking about the greatest story of all time. That's why, that's why these things have pretty sky high valuation in spite of not having any way to backfill the COVID revenue. So, so my biggest concern about BioNTech would be that I think their research is earlier stage. So they went out and bought a bunch of stuff that isn't even core to mRNA technology. So, to me, that says, okay, now you're in the same boat as everybody else, trying to refill your revenue stack with something that maybe isn't even core to your area of competence. So, maybe that's why we haven't done anything here yet. But I'll turn it back to Jason, because he's the one that spent more time on.
No, that's exactly why we haven't. You're getting a better, if you can assign a value to the research, and potentially you're getting a better value on that research by purchasing BioNTech. But as Mike said, the core mRNA vaccines business is that portion of the pipeline is earlier stage, and they went out and bought some antibody drug conjugate therapies, and that's later stage. Those are phase 2 and phase 3. So that, I think what they're seeing is like you guys were saying, they have to replace all that revenue from the COVID vaccine, and they're going out and getting the flashy hot thing, the ADCs, and they're later stage, and they're hoping that will be an approved therapy. And everyone was competing for those same companies that they acquired, and they paid up for it, but they had the cash on hand.
Great. I think we'll do more of this next week. In the meantime, everyone be well and stay healthy. And I especially like the notion that if the RNA vaccines can personalize, as Jason says, be effective against tumors, that'll be extraordinary outcome. And it may be someone else entirely. It may not be just because Moderna and BioNTech were the ones who did it with COVID vaccine doesn't necessarily mean that if this technology is successful against cancer, it'll be one of the two of them. It might be someone else entirely. But more on this next week. Take care, everyone. Bye-bye.
Listen up, I got something to say. The views expressed on this podcast are the host alone, and do not constitute an offer to sell, or a recommendation to purchase, or a solicitation of an offer to buy into security, nor recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have indeed verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future. The host may or may not hold positions in the securities mentioned.